A stock market crash is an impending threat, with experts sounding the alarm. But when will it hit? The world is a volatile place, and there are numerous potential triggers for market chaos. From the Trump administration and government shutdown jitters to tensions in the Middle East and a potential French government failure, the signs are worrying. Here's the real kicker. Investors are grappling with sticky inflation, interest rate uncertainty, and gloomy economic forecasts. There's a perfect storm brewing, and you need to be prepared. But here's where it gets controversial. Timing the market is nearly impossible, but experts have identified warning signals that could indicate a market meltdown. While no single indicator is a definitive sign, together they paint a picture of the market's health. The yield curve. This refers to the interest rate paid on bonds over time. Typically, longer-term bonds offer higher yields, but when the curve inverts, it's a red flag. Investors are paid more for short-term bonds, indicating that markets expect central banks to cut interest rates, a common recession indicator. Employment rates. Rising unemployment is a common sign of a bursting bubble and recession. When companies struggle, they make cuts, and a higher jobless rate is a cause for concern. The PMIs, Purchasing Managers Indexes, survey supply managers across industries, providing insights into economic growth. A drop in new orders and rising inventories can signal slowing growth, and experts are watching these numbers closely. Economic Surprise Index. This index, compiled by Citigroup, shows the difference between economic forecasts and actual results. A persistent negative surprise can indicate a shift in sentiment and economic growth outlook. Government deficits. The deficit is the gap between government spending and tax receipts. If it gets too big, it's paid for by borrowing, and a large deficit means higher interest payments. A mild budget imbalance is targeted by most governments, but when it reaches 3 to 5% of GDP, economic slowdown can occur. Government debt cost. Pay attention to the 10-year gilt yield, indicating the cost of UK government debt. A quick rise in yields is more concerning than the yield itself, as it can signal investor anxiety. Company results. Earnings downgrades, missed forecasts, and dividend cuts are warning signs. If these occur across multiple sectors, it could be a precursor to a sell-off. Investor sentiment. Investor behavior is crucial. When investors are bullish, asset prices rise, but when they become bearish and pull out, it can cause a crash. Speculative investments like meme stocks and cryptocurrency can indicate market exuberance, and metrics like the P/E ratio can help identify potential spikes. The VIX index. This measures market volatility over the next 30 days. When it goes above 25 to 30, it's often a precursor to a market dip. So what can you do to protect yourself? Stay informed, diversify your investments, and consider seeking professional advice. The market is a complex beast, and being prepared is key. What are your thoughts on these indicators? Do you think a crash is imminent? Or are these just normal market fluctuations? Let's discuss in the comments.